The number keeps going up. You open your brokerage app, green arrows, record highs, headlines celebrating another historic close. And somewhere in the back of your mind, a quiet voice you keep trying to ignore whispers, "This doesn't feel right." You're not wrong to listen to it. Because here's the thing nobody's saying plainly. The stock market and the actual economy stopped traveling together a long time ago. And the longer they pretend otherwise, the stranger the numbers look when you start asking the right questions. This isn't a prediction. It's not a warning to sell everything and move to a bunker. It's something more important, an honest look at what's actually happening beneath the surface of a market that keeps celebrating while the foundation quietly shifts. The disconnect nobody wants to name. Let's start with a simple question. If the stock market is supposed to reflect the health of the economy, why do the two keep moving in opposite directions? 2020. The global economy shut down. Businesses boarded their windows. Unemployment spiked to levels not seen since the Great Depression. And the stock market? After a brief, terrifying plunge, it roared back, hitting all-time highs within months of the most severe economic disruption in a generation. At the time, the explanation was optimism. Markets are forward-looking, they said. Investors were pricing in recovery. Maybe. But that explanation gets harder to sustain. When you look at what's happened since, the market keeps rising, and the questions keep multiplying. Corporate earnings growth has slowed. Consumer debt is climbing. Credit card delinquencies are ticking up. Small business formation, the real engine of economic vitality, has softened. And yet the index numbers on your screen suggest everything is fine. Better than fine. Historic. So either the market knows something the rest of us don't, or the market has become something different than what most people think it is. What the market actually is now. Here's the uncomfortable shift most financial media doesn't spend much time discussing. When people say the stock market, they typically mean the S&P 500. That index tracks 500 companies, but in practice, the index is not equally weighted. A handful of names, 5, maybe 6 companies, account for a disproportionate share of the entire index's movement, which means when headlines celebrate a record high, what they're often celebrating is a small group of technology companies had a good week. This matters more than it might seem, because those companies, the ones that dominate the index, are not representative of the broader economy. They don't employ most people. They don't reflect what's happening in manufacturing, agriculture, retail, or small business. They reflect the fortunes of an extraordinarily concentrated slice of corporate America. So the market is rising. But the market, increasingly, is not the economy. It's a scoreboard for a very specific game, one played by a very specific group of players. And those players have a significant advantage that most individual investors don't: the money that changed everything. To understand why markets behave the way they do now, you have to understand what happened to interest rates. For most of the decade following the 2008 financial crisis, central banks held rates near zero. The logic was straightforward. Cheap money encourages borrowing. Borrowing encourages spending. Spending drives growth. Emergency medicine for a broken system. But something unexpected happened. The cheap money didn't only flow into the real economy, it flowed massively into financial assets. When the return on a savings account is essentially zero, and the return on a government bond is not much better, money naturally seeks higher ground: stocks, real estate, private equity, anything with a yield. And when trillions of dollars chase a fixed pool of assets, those assets get more expensive. Not because the underlying businesses got dramatically better, because there was simply more money competing for the same shares. This dynamic doesn't get discussed enough in the context of market performance. A significant portion of what people interpret as the economy is doing well is actually there is an enormous amount of capital that needs somewhere to go. That's a different story, and it has different implications. The buyback machine. There's another mechanism quietly pumping air into these numbers, and it's entirely legal, widely practiced, and almost never explained to ordinary investors in plain terms. Stock buybacks. When a company generates profit, It has choices. It can invest in new equipment, hire more people, research new products, or pay dividends to shareholders. Or, and this has become the dominant preference, it can use that profit to buy its own shares back from the market. When a company reduces the number of shares outstanding, earnings per share goes up, even if total earnings stay flat, which means the stock looks more valuable by one of the most commonly cited metrics, without the company actually doing anything more productive. In the years following the 2017 tax cuts, American corporations engaged in share buybacks at a scale that had no historical precedent. Trillions of dollars, not building factories, not raising wages, repurchasing their own equity, which, not coincidentally, directly increases the value of the stock options held by the executives making those decisions. The market celebrated. Of course it did. The numbers looked great, and in a narrow technical sense, they were great for shareholders, but great for shareholders and great for the economy are not the same sentence. The retail investor enters the room. Then came the next layer. The democratization of investing. Zero-commission trading apps, fractional shares, financial content that made the market feel accessible, exciting, even urgent. A new generation of investors poured in. Some were sophisticated, many were not, but all of them brought capital, and all of them were receiving the same basic message. The market goes up over time, so get in. This isn't wrong. Historically, it's broadly true. But context got lost in the simplification, because what most people weren't told is that the entry point matters enormously, and that markets priced at historical extremes by almost every valuation metric, price to earnings, price to sales, the Shiller-Cape ratio, do not necessarily behave like markets at historical averages. When ordinary people flood into an already elevated market, they often end up holding the most expensive version of it. They get the celebration after the party started. And when the mood shifts, when the institutional money that moved first decides to rotate out, retail investors frequently find themselves on the other side of those trades. This isn't conspiracy, it's structure. It's how markets have always worked. The information asymmetry has always existed. What changed is the scale of retail participation and the confidence with which people entered without fully understanding the terrain. What the numbers are hiding. There's a version of the economy is strong that is technically true and practically misleading at the same time. GDP growth, low official unemployment, corporate profits near record highs. On paper, the picture looks healthy. But economic data has a way of flattening the texture of what's actually happening. Unemployment can be low because people stopped looking for work, not because the labor market is thriving. GDP can grow while household financial stress increases, if that growth is concentrated in sectors and income levels that most people don't participate in. Corporate profits can be record high, while real wages, adjusted for what things actually cost, have barely moved for large segments of the workforce. Consumer spending drives a significant portion of the American economy. For the past few years, that spending has been sustained, but sustained increasingly by debt. Credit card balances have reached levels that were historically associated with financial stress. Savings rates have declined. The buffer that households built during the pandemic years has been drawn down. The machine is still running, but you can hear it straining, and the market, which is supposed to be a forward-looking instrument pricing in future earnings, seems remarkably unconcerned. The confidence paradox. Markets run on belief. This is not a cynical observation. It's a structural one. When enough participants believe prices will rise, they buy. When they buy, prices rise, which confirms the belief, which attracts more buyers. This is how bull markets sustain themselves. And it's also why they can keep going long after the underlying fundamentals would seem to justify caution. John Maynard Keynes, one of the more clear-eyed economists of the 20th century, described the market as a beauty contest, not where you pick the most attractive face, but where you try to predict which face other contestants will find most attractive. The goal isn't truth, it's anticipating consensus. That insight has never been more relevant than it is today. In an era of algorithmic trading, passive index funds that buy regardless of valuation, and social media loops that amplify momentum in both directions. The market's relationship with fundamental reality has become genuinely complex, which raises a question nobody can fully answer. If confidence is self-reinforcing on the way up, what happens when it shifts? Not gradually, as a slow correction, but quickly, the way it sometimes does when a narrative breaks and the underlying structure becomes visible all at once? History has an opinion. It isn't always comfortable. What smart behavior looks like here. This isn't the part where the script tells you to panic. It isn't the part where we predict a crash, name a date, or sell you a particular investment as the answer. What this is instead is a case for clarity. Understand what you own. If you're invested in broad index funds, recognize that your exposure is significantly concentrated in a small number of large technology companies, and think about whether that reflects a deliberate choice or an assumption you haven't examined. Question the framing. When markets hit record highs and the coverage is celebratory, ask what's driving those highs. Is it earnings growth from underlying business performance? Is it buybacks? Is it rate expectations? Is it momentum and sentiment? The driver matters because different drivers carry different risks. Time horizon is everything. The long-term case for equity investing remains historically supported, but long-term is not a shield against short-term volatility that can be devastating if you need liquidity at the wrong moment. How long you have matters as much as what you own, and perhaps most importantly, resist the pressure to confuse the market's performance with your own financial reality. The S&P 500 hitting a new high doesn't mean your financial situation improved. It means a collection of large companies' equity is more expensive today than it was yesterday. Those are related ideas, but they are not the same idea. The number keeps going up, and maybe it keeps going up tomorrow, maybe next month, maybe for longer than anyone who's worried about it expects. Markets have a way of making the cautious look foolish and the complacent look wise. Right up until the moment they don't, what's worth sitting with isn't whether the number will keep rising. It's whether the story being told about why it's rising is actually the full story. Because markets tell us what things cost, they don't always tell us what things are worth. That difference between price and value, between the scoreboard and the game, has mattered before. Profoundly, historically, to real people with real consequences. The voice in the back of your mind that says something feels off, it might just be the most financially intelligent thing about you.